Most people don't realize this, but the greatest returns in history have rarely come from following conventional wisdom. They came from understanding timing, cycles, and fundamental shifts before they became obvious. Today, we're standing on the edge of one of those moments again. And if you understand what's happening underneath the surface, where the world is headed, this single investment opportunity might not just grow your portfolio, it could multiply it by 10, not through gambling, not through hype, but through timing, insight, and positioning ahead of the curve. Throughout history, there are patterns, cycles that repeat, not perfectly, but rhythmically. People tend to believe that what they're experiencing at the moment is unique. But when you step back and study the past carefully, you see that most of what feels new has already happened, just under different circumstances with different character. The names change, the technologies change, but the human behaviors, fear, greed, overconfidence, denial, remain consistent. And those behaviors shape the markets, economies, and investment outcomes again and again. We've seen empires rise and fall, currencies gain and lose dominance, booms turn into busts, and then booms again. Each time, most people are surprised, but they shouldn't be. Because if you've taken the time to understand the forces that have driven change across centuries, debt accumulation, innovation cycles, political fragmentation, monetary expansion, you begin to notice when similar forces are building again. The 1920s had its wild market speculation, followed by the crash and the Great Depression. The 1970s brought us stagflation and the collapse of the Bretton Woods system. The 2008 crisis was the bursting of a massive credit bubble, which had been building in plain sight for years. And today we're again watching massive debts mount, geopolitical tensions rise, and central banks using monetary tools that have long-term consequences. None of this is new. The environment is evolving, but the underlying patterns, how people react to risk and opportunity, are most people focus on the present. They watch the news, follow quarterly earnings, look for headlines that move the market. But to truly understand where we're headed, you need to zoom out. Look at the long arc of history. What has happened when interest rates hit zero for extended periods? What follows when wealth gaps become too wide? What precedes a change in the world reserve currency? These aren't theoretical questions. They have real historical answers. One of the most important patterns to recognize is the debt cycle. Over time, as credit expands, it fuels growth. Consumers borrow, businesses invest, asset prices rise. It feels great, but eventually the debt burdens grow too large to be sustained, payments become harder to meet, and then suddenly credit contracts. Defaults rise, markets correct, and policymakers respond with more easing, more stimulus, often pushing the problem further down the road. If that pattern continues long enough, eventually the ability to stimulate runs out and a major reset occurs. Understanding these cycles helps you anticipate what most people will only react to, and that gives you an edge. It doesn't mean you can predict exact moments, but it means you can position yourself for probabilities. When something has happened repeatedly across geographies and centuries, and the same indicators are flashing again, it would be foolish not to take it seriously. Another critical historical pattern is the shifting of world powers. Dominant nations often rise through a combination of strong education, innovation, capital markets, and military strength. But over time, success breeds complacency. Debts rise, productivity slows, internal conflict increases. Meanwhile, another nation, usually one that has been growing quietly, investing in infrastructure and human capital, begins to challenge that dominance. This transition doesn't happen overnight, but when it does, it reshapes the global economy, trade flows, and where investment capital seeks safety and return. People often ignore these transitions until they're obvious. But by then, the best opportunities are gone and the biggest risks are entrenched. The intelligent investor watches the patterns. They look beyond national headlines and study the indicators. Currency reserves, education data, manufacturing growth, energy strategy. They understand that the forces shaping the future are not just monetary policy or quarterly profits, but long-term shifts that have occurred again and again in human history. Markets are not machines. They are reflections of human nature, and human nature does not change. That's why studying history is not an academic exercise. It's a practical tool for investing wisely. It tells you when to be cautious and when to be bold. It gives you a sense of where the crowd is headed and whether you should follow it or not. Most people ignore history. They think it's irrelevant. They chase what's hot, avoid what's scary, and end up buying high and selling low. But those who study the past, who understand the rhythms of time, can anticipate the inflection points. They don't need to predict the future. They only need to recognize when we've seen something like this before. Because if you understand that history shows patterns and you align your actions with those insights, then you give yourself the rare ability to not just protect your wealth, but to grow it when others are blind to the risks and the opportunities. Throughout time, the world has experienced fundamental shifts, technological, geopolitical, and economic, that have led to the birth of entirely new asset classes. These shifts were rarely obvious in the moment. In fact, most investors failed to recognize their potential until the gains had already materialized. The ones who benefited the most were those who studied long-term structural changes, saw the direction of progress, and positioned themselves early before the crowd arrived. There was a time when owning railroads was seen as speculative. Then came steel, then oil. Later, the telephone and electricity became legitimate investment domains. In every case, it started with doubt, with resistance. The crowd didn't understand the innovation or saw too many risks. But those who stepped back and looked at the forces beneath the surface, productivity, scale, cost efficiency, understood that these were not passing trends. They were the foundations of future economic growth. The same pattern repeated itself with technology. In the 1990s, when the internet was still in its infancy, most investors dismissed it. They couldn't see how digital networks would reshape commerce, communication, and entire industries. But those who understood that this was not just a technological breakthrough, but a paradigm shift in how value is created and exchanged, were able to capture returns that seemed almost unimaginable at the time. We are at a similar juncture again today. New asset classes are emerging, not in theory, but in reality. They're being formed through a combination of necessity, innovation, and long-term structural transformation. These assets may not yet be fully understood or broadly accepted, but the signs of their growing importance are visible to anyone looking carefully. As always, the institutions are slower to move, regulation lags. Media narratives fluctuate, but capital is beginning to flow, and where capital goes, returns often follow. These emerging opportunities often come from solving real-world problems. Think about the pressures we're facing: climate volatility, aging infrastructure, broken financial systems, and resource scarcity. The investments that are rising in importance today are not based on speculation. They are based on addressing these realities. They involve digital infrastructure, alternative energy, decentralized financial systems, and technologies that enhance efficiency in a world constrained by debt and demographic decline. At first glance, these investments may seem unconventional. They don't fit neatly into traditional asset allocation models. They aren't always liquid or easy to evaluate using standard metrics. But the world is not operating on traditional models anymore. We're entering a period where long-standing systems are being reevaluated, and with that comes the need for adaptive frameworks, both in policy and in investment. Throughout history, the same dynamic is played out. At first, people resist change. Then they dismiss it. Then they ridicule it. And finally, they chase it. By the time the crowd recognizes something as a legitimate investment, the returns have largely been captured. That's why the most successful investors focus not on what is, but on what is becoming. They look beyond the noise, study the fundamentals, and align themselves with the future before it becomes obvious. This requires a mindset that values long-term thinking over short-term comfort. It requires tolerating volatility, being misunderstood, and often going against the herd. But history has shown that these moments, these transitions, are where the greatest opportunities lie. It's not about predicting the future with certainty. It's about identifying where the probability of outsized returns outweighs the risk based on a deep understanding of structural shifts. We are witnessing the early stages of a transformation in how assets are created, valued, and exchanged. The question is not whether these new asset classes will become important. That's already happening. The question is, will you recognize their importance before they are fully priced in? Or will you, like many in the past, only realize it after the moment has passed? In investing, the edge lies in recognizing that the world is always changing and in knowing how to change with it. The rise of new asset classes is not a disruption, it's a continuation of the historical pattern of innovation reshaping capital. Those who understand this will be prepared. Those who don't will be surprised, as they have been time and again. The most successful investors throughout history have never aimed to eliminate risk. Instead, they've learned how to manage it, position around it, and most importantly, identify when the potential reward far outweighs the downside. This concept, what some call asymmetric risk to reward, isn't just a theory. It's a principle grounded in the way the world actually works. When applied correctly, it can change the entire trajectory of a portfolio, not through frequent wins, but through a few major outcomes that matter disproportionately more than the rest. Every decision carries risk. That's a constant. But what varies is how that risk compares to the potential return. Most people seek comfort. They chase certainty. They invest in what's familiar, what's safe, often without realizing that the so-called safe assets can carry the most invisible risks, especially when inflation, interest rates, or broader systemic forces shift unexpectedly. On the other hand, the best opportunities often lie where others are unwilling to look, where there's discomfort, confusion, and uncertainty. But here's the key. Those uncomfortable investments only become valuable if the downside is limited and the upside is exponential. That's asymmetry. You risk a little, but if the thesis plays out, you gain a lot. Over time, this approach doesn't require you to be right often. It just requires you to be positioned correctly for the one or two outcomes that shift the landscape. This type of thinking requires discipline. It demands that you analyze not just whether something could go up or down, but how much you can realistically lose and how much you could potentially gain. Most people get stuck in binary thinking. Will this work or not? But the truth is, investing isn't about being right all the time. It's about having a process where your wins are large and your losses are contained. Asymmetric bets are rarely found in places that are crowded. You don't find them in overbought sectors or assets trading at euphoric valuations. They emerge in overlooked corners of the market, in misunderstood technologies, in regions undergoing transformation, in systems being rebuilt out of necessity. They arise when the broader market is too focused on short-term noise to see long-term value. One of the greatest examples of asymmetry lies in the early adoption of new paradigms. When something foundational changes, how people store value, how they transfer it, how they create energy, how they build infrastructure, there's often a window where the opportunity is obvious to only a few. The perceived risk is high because the frameworks don't yet exist to understand it. But for those who've studied history, who recognize the signals, the risk is not as large as it seems. In fact, it's often exaggerated. Managing risk doesn't mean avoiding it. It means structuring your exposure so that even if you're wrong, your downside is manageable. That can be done through position sizing, diversification, or simply by understanding the depth of what you're investing in. You don't put everything on the line. You make calculated decisions, knowing that one outsized success can pay for multiple small failures. This is how wealth is built over time, slowly, thoughtfully, and with an eye for imbalance. Asymmetry isn't about taking wild gambles. It's about finding places where the market has mispriced something, not because of faulty math, but because of psychology, fear, or inertia. The market, after all, is made up of people, and people are not rational machines. They overreact, they underreact, and they cling to the familiar even as the world changes around them. That's where the edge comes in. Seeing where fear has created discount, understanding where complexity has discouraged analysis, recognizing where a shift in the macro environment is quietly creating new pathways for capital. When you find those areas and when the numbers work, that is when the upside is multiples of the potential downside. You don't need a crystal ball. You need the courage to act while others hesitate. Over the course of a lifetime, a few asymmetric bets, placed carefully, sized responsibly, and held patiently, can do more than 100 conventional trades ever could. They change not just the returns you generate, but the way you see risk altogether. Because in the end, the greatest risk is not volatility. It's the risk of missing those rare windows where the reward vastly outweighs what you put on the table. Those who recognize that distinction are the ones who win, not occasionally, but consistently over decades. If you want to understand where the best investment opportunities will emerge, you have to understand where capital is flowing, and more importantly, why it's flowing there. Capital doesn't move randomly. It follows power, productivity, and policy. It flows toward safety when fear is high, toward growth when optimism returns, and toward innovation when long-term cycles begin to shift. And beneath all of it is a set of global forces, economic, political, technological, that shape the world we live in and the portfolios we build. Throughout history, capital has always sought returns adjusted for risk. But what constitutes risk and return changes depending on the broader environment. During times of geopolitical stability, investors chase growth. During periods of uncertainty, they prioritize preservation. These decisions are not made in isolation. They are driven by central banks, trade relationships, fiscal policy, demographic shifts, military dynamics, and the rise and fall of empires. To understand where we are today, we need to look at the larger global picture. The post-World War II order created a system in which the US dollar became the world's reserve currency. This status gave the US the ability to print the global medium of exchange, which in turn shaped where and how capital flowed. Emerging markets grew in the shadow of that system, benefiting from trade, access to capital, and the globalization of supply chains. But systems are not static. Over time, debts build, imbalances grow, and power begins to shift. What we're witnessing now is the early stage of a global rebalancing. China's rise is not just economic, it's strategic. It's altering trade flows, reserve currency holdings, military alliances, and investment behavior. At the same time, Western economies are burdened by aging populations, unfunded liabilities, and growing political fragmentation. These conditions influence how attractive a market is, not just from a growth standpoint. And when investors start to question the rules of the game, they begin to look elsewhere. This shift in capital is not abrupt, it's gradual, but it accelerates when certain tipping points are reached. One of those points is trust. When trust in a country's currency, legal system, or political leadership begins to erode, capital moves. Sometimes quietly, through changes in bond buying or foreign direct investment, sometimes loudly through currency devaluations or credit crises. Either way, the shift happens, and those who are paying attention position themselves accordingly. Another key force shaping capital flows today is technology. Digital infrastructure is reducing the importance of geographic proximity. Countries that embrace digital finance, AI, clean energy, and decentralized systems are attracting capital not just because they are growing, but because they are adapting. Investors reward adaptability. They punish stagnation. When governments resist change, when they protect old industries at the expense of new ones, capital leaves. And once it leaves, it's hard to get back. It's also important to understand that capital is not just money, it's confidence. Investors are constantly evaluating the rule of law, the ease of doing business, the independence of institutions. These qualitative factors are often more powerful than the quantitative ones. Two countries can have the same GDP growth, but if one has stronger property rights, transparent regulations, and a culture of innovation, capital will favor it. Over time, this preference compounds and the gap between winners and losers widens. History has shown that being on the wrong side of global capital flows can devastate a nation's economy. Think of countries that failed to control inflation, that defaulted on their debt, or that imposed capital controls. Investors don't forget, once capital leaves due to instability or mismanagement, it takes a long time to return, if it ever does. That's why understanding the underlying forces behind capital movement is not optional, it's essential. For investors, the goal is to be ahead of these flows, not in a speculative sense, but in a strategic one. You study where power is consolidating, where growth is being encouraged, where policy is aligning with innovation, and you position your portfolio to benefit from those movements, knowing that the most durable returns are not found where capital already is, but where it is going. In a world that is increasingly interconnected, yet fragmented, you can't afford to look at assets in isolation. You have to see the whole map, the movements between currencies, between regions, between asset classes. You follow the incentives, the signals, the shifts in momentum. And when you do, you don't just chase returns, you understand them. You don't just react to news, you anticipate it. And that is what separates those who survive cycles from those who thrive across them. The greatest returns are often made not when things are obvious, but when they're uncomfortable. Real opportunity exists in the gap between perception and reality, between what the majority believes and what the fundamentals are quietly revealing. Positioning before the herd arrives means having the discipline, the humility, and the historical awareness to see what others don't yet recognize or are not yet willing to confront. That edge doesn't come from guessing. It comes from studying cycles, tracking signals, and understanding behavior. Throughout time, the crowd has always arrived late. When the consensus finally agrees something is a good investment, the upside is already priced in. By then, the environment is saturated, the value has been extracted, and the risk to reward has shifted dramatically. Markets move in anticipation. Capital flows to where the story is just beginning, not where it's already been told 1,000 times. This is not a critique of human behavior, it's an acknowledgement of how systems work. People seek validation in numbers and popularity. They feel safer when everyone else agrees. But markets don't reward safety. They reward foresight. Being early strategically, not recklessly, is how asymmetric outcomes are created. The challenge is that early positioning almost always feels wrong in the moment. It contradicts headlines. It lacks consensus. It may even generate short-term losses. But over time, those who can endure the noise and stay anchored to fundamentals often find themselves in positions of strength when the shift finally happens. Positioning early is not the same as predicting the future. It's about identifying structural trends, recognizing distortions, and understanding where the incentives are pointing. It involves careful observation of macroeconomic indicators, capital allocation patterns, and innovation cycles. When multiple variables begin pointing in the same direction, even if the crowd hasn't noticed, it's time to pay attention. Take, for example, the early days of emerging markets, or the rise of the internet, or even commodity cycle. The signals were there: currency reserves rising, productivity improving, technology scaling, but they were overlooked or dismissed. The crowd was focused elsewhere. By the time the headlines caught up, the best entry points were gone. This happens again and again. The environments change, the assets change, but the behavioral patterns stay the same. There is always discomfort in going first. The data may be incomplete, the story may still be developing, but that's precisely what creates the opportunity. When something is universally accepted, it's already priced in. When something is ignored or misunderstood, it's often mispriced. That's where the edge lies, not in certainty, but in calculated anticipation. Being early also requires risk management. It doesn't mean making concentrated bets on unproven ideas. It means building exposure in ways that limit downside while maintaining the ability to benefit if the thesis plays out. That's the art. Having the conviction to act while remaining humble enough to know you could be wrong. And if you are wrong, it shouldn't cost you everything. If you're right, it should move the needle. One of the most misunderstood aspects of positioning early is that it's not about speed, it's about patience. Markets don't always move on your timeline. The process of recognition takes time. Narratives need to develop, capital needs to shift, policy needs to adapt. But when the ingredients are in place, the transition can accelerate quickly. If you wait until it's obvious, you've already missed the exponential phase. The returns will be linear at best, and the volatility will be higher because you're entering at a crowded point. Another reason early positioning works is because it reflects independent thinking. Most investors aren't truly independent. They're anchored to benchmarks, peer performance, and quarterly optics. But the best opportunities don't align with quarters, they align with cycles. If your framework is built on short-term confirmation, you will always be late. If it's built on structural understanding, you have a chance to be early and right. In every cycle, there are signals that things are shifting beneath the surface. They're often subtle at first. Changes in market internals, policy direction, investor sentiment, or cost curves. These signals rarely scream, they whisper. And those who are listening, who are looking beyond the surface, can begin to prepare, not react, prepare. Positioning before the herd isn't glamorous. There's no immediate payoff. In fact, you might look wrong for a while. But the goal isn't to look right. It's to be positioned well when the tide turns. Because once the herd arrives, the opportunity becomes risk. And by then, those who saw it early are already harvesting the rewards. That's the discipline. That's the edge. Understanding when to move, not with the crowd, but just before it gathers, it's what turns insight into outcomes and knowledge into long-term advantage. The best investors in history didn't just look at balance sheets or charts. They looked at history, at patterns, at human behavior. And they asked, where is the world going next, and how do I position myself before the crowd? This moment right now might be one of those rare inflection points. You don't need to be a genius to capitalize on it. You just need to be aware, open-minded, and bold enough to act before the rest of the world catches on. Because by the time everyone else sees it, it's already too late. This investment might 10x your portfolio, not because it's magic, but because you understood the timing, you saw the signs, and you acted before the narrative became obvious,